Good evening, everyone. I am Piyush Sinha, your moderator for this webinar today. We are delighted to welcome you all in this enlightening session being organized by the Continuing Professional Education Committee of the Institute of Chartered Accountant of India. It's my pleasure to be moderator of this webinar on NRI Taxation and DTAA and later corporate governance. In a short while, we will start this webinar. Before that, first, I would like to appraise you about the CP committee, which is organizing this webinar. In today, our changing professional scenario worldwide, the biggest challenge the professional faces is how to stay on the top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspective. In this context, continuing professional education facilities professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinar, seminar, etc. The webinar for this evening is as follow. We have two sessions of 1 hour each. And the topics are as follow. First, we will go through the non-resident taxation and remittance with a special focus to section 195 and DTAA. And later we will understand about the corporate governance, a stakeholder perspective. Again, we are delighted to welcome you all to this session of non-resident taxation and remittance, section 195. As part of our continuing professional education initiative, we strive to bring you the most pertaining to the cutting-edge topics in our professional domain. Today, we will delve into the complexities and nuances of non-resident taxation and remittance with a specific focus on Section 195 and double taxation avoidance agreement. This subject is of paramount importance in today's globalized economy where cross-border transactions and international tax compliances are becoming increasingly prevalent. The primary theme of this session is to provide a comprehensive understanding of the regulatory framework and practical implication associated with the non-resident taxation and remittance. We will explore Section 195 of the Income Tax Act, which governs the tax deduction on payment to non-resident, and scrutinize the provision of DTAA that aim to mitigate double taxation on the same income. Our distinguished speaker who are expert in this field, we will share their invaluable insights and experience helping us navigate through the complexity of these regulations. They'll shed light on the challenges faced by the professional in ensuring compliances and provide guidance on leveraging the benefit of DTAA in various scenarios. On our first eminent speaker for today's webinar, CA Kusai Goiwala sir. He is from Pune. He was nominated for 3 years to the INDA's Implementation Committee of the Institute of Chartered Accountant of India and on Research Committee for the year 2021. He has taken numerous lectures on various topics like tax audit, IFRS, INDAS, auditing standard, ICDS, company law, GST, FEMA, etc. in seminar conducted by the ICI, ICSI, and ICMI. He was a part of group which authored, reviewed various publications like the most prominent is the guidance note on internal audit for the automobile industry. So now I would like to hand over to the Kusai Goiwala sir. Over to you, sir.
Thank you, Piyush. Thank you very much for a nice introduction and kind words. First of all, I would like to thank the CP committee, including, particularly the chairman of the committee, Purushottam ji, Khandelwal ji, the vice chairman, Gyan Chandra Mishra ji, and my co-speaker, Chaudhary ji, and other my professional colleagues who are there in this particular webinar. And a very good evening to all of you. As rightly mentioned by Piyush ji, a very important topic, that is what we are going to discuss today about the NRI taxation and Section 195. Before I go into it, let me just share my screen. We are going to discuss today a very critical component of non-resident taxation, particularly the remittances which are made to a non-resident, Section 195, how it applies, what are the nuances of Section 195, how to implement a very important DTA between the two countries, and what are the important aspects to be considered while certifying certain forms under the Income Tax Act. So we will discuss in detail about these aspects. Okay. Now, our agenda for today is very clearly defined. Types of residential status. I mean, anything about non-resident cannot be complete unless you really know who is a non-resident. Unless you know who is a non-resident, we will not be in a position to implement it correctly. Scope of total income. What is the income which is taxable in India, and in what kind of status taxable, that we will discuss in detail. Income deemed to arise in India, Section 9, which is very important, which really brings about the income which is arising in India. And there are certain deeming provisions which we will discuss. There are certain exemptions for non-residents we will discuss in brief, because I mean in 45 minutes or 50 minutes probably allotted to me, a topic is too wide to probably discuss the entire thing in detail. We will quickly glance through certain very important provisions. I would request the CP committee to share my PPT with the participants so that they get the background material for them to look at it at their leisure. And there are special tax provisions for non-residents, Section 115 and all those kind of things, which we will discuss. Now we talk about DTA. That DTA we will discuss as to what is the implications on our taxation and remittances under Section 195. And as I mentioned to you, the DTA provisions. So these are our basic agenda for today. Let's look at the type of residential status. As far as income tax is concerned, we are all aware that there are three types of residential status. One is purely resident, and in resident there are again two subcategories. One is ordinary resident, that is a pure resident, and then there is another subcategory called resident but not ordinary resident. There are different taxation aspects in this. We will discuss it later. And there is a second category, which is a non-resident, pure non-resident. Now, up to about a few years, several years back, this non-resident definition was very, very simple, and it was been continued for ages. But last, I think from 1718 onwards, there has been an amendment, and that has created a lot of new complications, as well as it has created how to really compute whether it is a non-resident or is a resident or is ordinary resident. And this is what we are going to discuss as to what are the complications for this status. Now, it is very clearly defined under the Act that who is not a resident as per Section. So what has happened is the Act has defined the residential status, and who is not falling into residential status will go under the non-residential status. Now, let me share with you little important aspect here. We also deal with FEMA. And when it is talking about non-resident payments, also FEMA comes into play. And why this particular taxation of non-resident is very critical is in two aspects. One, Section 195 or the taxing section under Income Tax Act, which requires some withholding tax for any payment made to a non-resident, is a very stringent provision, and TDS provisions, we all are aware, are very stringent, and any violation in TDS provisions, including 195, will entail prosecutions and huge amount of penalties, and including the prosecution is initiated by the department. So that is one aspect as far as the Income Tax Act is concerned. But under FEMA also, the requirement is very simple, that any payment going outside India, there has to be two types of compliances. One compliance is in respect of FEMA compliances, whether it is permissible to send money outside India. So that one has to see whether it is permissible. Secondly, no payment can be made, even if it is permissible under the FEMA law, unless tax on that has been deducted from that source organ. If the tax as applicable has been deducted, then only the payment is allowed under FEMA. So if the tax is not properly deducted under 195, then you are not only not complying with Income Tax Act, but you are also not complying with FEMA, where your payment has been made outside India, the foreign exchange has been paid outside India without deducting of tax, and that amounts to violation under FEMA also. That payment is not as per in compliance with the FEMA. And now, see what is the government's perspective, that once the money goes out of the country, it is very difficult for that tax to be collected from that person who has already received the money outside India. unless the tax has been withheld and paid to the government. And here, generally the entire amount of tax that is required on that particular transaction is required to be withheld. It is not some very small percentage like on a contractual payment, we do 2% or 1%. No, we have whatever is relevant. So we have got various rules for that, and we will explain you that rule. In some cases, there are taxes at a lower rate. Now, why at a lower rate? That also I will explain you. So now we will look at the first definition of resident as to who is a resident. It's been very standard and not very volatile, but there are some changes which has happened here. A person who is, there are two conditions, and any one condition is satisfied, he becomes a resident. So if he stays in India in the previous year, we all know what is the previous year, for 182 days or more, then he becomes a resident in India. Now here, if you see in the Income Tax Act, the focus is on the number of days, whereas in the FEMA, number of days also is there, but the main focus is on the intention. If a person goes outside India for employment, then irrespective of number of days, he becomes a non-resident. Whereas in income tax, it is not that way. Irrespective of the intention, it is basically the number of days are very important, and it has to be calculated. So first, he stays in India for 182 days or more in previous year, or if he has stayed in preceding 4 years, 365 days in or more in India, and during the financial year, during the previous year, he has stayed for 60 days. So then, if both the tests, any one of them is complied with, it becomes resident. And if both the tests are not complied, then only becomes a non-resident. So this is a resident. Now then, there is another thing. Okay, a person of who is on a ship continuously moving out. So if he is moving out, so 60 days is too less for that period. So that 60 days is substituted for 182 days for those people who are living for employment during the year. Suppose somebody has left for employment in somewhere in let's say November or December. So he might stay in India for 60 days. So he becomes a resident. So here 182 days period is substituted. So somebody who has gone in July or August may still become non-resident. A citizen of India or a person of Indian origin who comes to India during the second condition. Now, again, 180 days. Who has come to India during the year, again, that 60 days becomes 182 days. So then you get a higher pedestal for a non-residential status. Now, this is very interesting. The above person who has the Indian source exceeding 15 lakhs and he has stayed, then the 60 days again is substituted for 120 days. So here again, that 180 days and 60 days gone, it is 120 days. So there is a complication has been added. There is an explanation 1B which has been added, and this has created little complications in terms of you have to look at the Indian source income. The income which is earned in India by that person, if it is exceeding 15 lakhs, then that 60 days becomes 120 days in India. So these are the main nuances of the. Now let me take one case study as to how it works. Mr. X, who is a citizen, Indian citizen, now this applies to Indian citizen, and spent 176 days in India during the relevant assessment year, and more than 365 days in the preceding previous year. Now that means he has not stayed for 182 days in the current year. Now he went to Mauritius on an occupation permit to stay and work as an investor and not as an employee. Now see, during the year he went outside India, not for employment, but for an investor to get some business, to go and do some business out there, to get some business and to do a business in Mauritius. Now, what is his residential status? Now, here it is very important. The wording which I mentioned to you about that going out of India for an employment, there has been several judgments which says that employment does not only mean that employment for somebody else. You are working for somebody. Even self-employment is also considered as an employment, and there are judgments. So when he has gone for self-employment or business also, it would be treated as a employment, and that same principle will apply for an employment. So similar issue has been decided in Honorable Bench of Bombay Tribunal in case of ACIT versus Nissan Kanodia, where it has been held that employment includes self-employment also. SSC is entitled to claim the benefit of the extended 182 days and not 60 days. So that is a difference with this judgment. Now, there is another second category of resident, but not ordinary resident, section 666. Again, here a person who is not any one of the condition, if he is satisfied, then he becomes R but NOR. Now, a person who is not a resident in 9 out of 10 preceding, he has been staying out of India for several years, Now, he comes to India for 2 years, that is, till the time he does not exhaust that 9 out of 10 years condition. then if he stays 8 out of 10, matlab 2 years he becomes resident, then only he becomes a pure resident, and till the time he still remains resident but not ordinarily resident. So this is one of the benefit of staying outside India for a long period of time, because there are certain taxability aspect of his total income, world income, and we will discuss that as to what is the difference. Now, again, here also there has been a condition: a citizen of India or a person who becomes with income of 15 lakhs during the previous year and stays for 120 days but less than 182 days, he becomes R but NOR and not pure resident. Okay. So we saw in that earlier case, the resident, that if he has got 15 lakhs in income, he becomes resident, but he is not pure resident, but he becomes resident but not ordinary resident, who has got 15 lakhs of income, but he has stayed for 122 days but less than 182 days. Now, again, there is a deemed resident. There is another category. Now, they have introduced under section 6(1)(a), which is called a deeming provision. Now, it is irrespective of number of days, wherever he stays, it doesn't matter. Even if he stays outside India for all 365 days, he is outside India. But he is not a tax resident for any of the country. Like a person is a nomad. He keeps traveling. He goes 2 months, he stays in Mauritius, 2 months in some another country, 2 months in another country. He never becomes a resident of any country. He just travels world over. But he is not a resident of any country, but he is not staying in India, not a single day in India. In spite of that, he will become a resident in India. The reason is because he is not a tax resident of any other country. Now, that means he will be, again, that means citizen of India staying outside even for a year, but not a resident for any other tax jurisdiction, having income exceeding 15 lakhs in India, will be R but NOR. Now, here again, 15 lakhs is the criteria. Okay. So if you have a more than 15 lakhs of income and you are not a tax resident of any other country, and you have not stayed for India for even a single day, but you will still become a deemed R but NOR. Okay. So one should obtain a TRC or a TIN of the foreign country to prove that, yes, I am a tax resident of a foreign country. Now, what happens to some countries where there is no tax, there is no taxation, but yes, there are DTAA, like with UAE, there is a DTAA, and they can obtain a tax residency certificate from those countries and can prove that, yes, they are. And I've got clients who have got TRC from UAE also, although there is not income tax in UAE, but they can obtain from their government tax residency certificate that they are a resident of this particular country. And because of that, they will not be liable for being a resident but NOR in India. They can still get a non-resident status. So above person will be deemed to be a resident but not ordinarily resident. Now, this is a graphical presentation of the same thing what I've explained, so that we can understand in a very easy way. There are two things: 182 days or more is a resident, less than 182 days, then you have to look at various permutations. Indian citizen, person, 15 lakhs or more, then resident but not ordinary resident. If it is 120 days or more, 120 days or more, but less than 182 days, he can still be R but NOR, 15 lakh ka income dekhna hai. Agar if he is not an Indian citizen, then he becomes non-resident. Now, this 15 lakhs wala income is applicable only to Indian citizens. Now, see, this citizenship criteria was never there in income tax. Now, this has been introduced through this amendment, and that is where the citizenship comes into play. Otherwise, it is always the residential status, irrespective of your citizenship. Now, how to compute number of days? This is very important. And sometimes somebody is on a borderline, like 181 days or 182 days or 183 days. How do you really compute? Whether it's a non-resident or resident, either ways can change the entire scenario. One day can make a lot of difference. So the day day of arrival in India and day of exit will be counted as days in India. For example, somebody is, coming to India at, let's say, in the midnight, at let's say 11:45, before 12 midnight. Now he will be considered as stayed for earlier day also, because although 15 minutes of the earlier day, but that day will be counted on when the entry stamp is of that day. It will be considered as the entire day will be counted. And if he is exiting at 12:15, even the next day will be counted as in India, even though he has just stayed in India for 15 minutes, or he has come to India for only 15 minutes in that particular day, even though that day will be considered as the day in India. So you have to always consider the 2 days where he is when he has entered or when he has exited, those days are also considered for the purpose of counting those 182 days. So you have to be very careful when you are doing this. When the person is just at a borderline, you should be very sure what Mr. X, who came to India for visiting his relatives on 1st April and left on 2nd October, definitely is, but in the preceding 4 financial years, he has stayed in India for 300 days. How many days he stayed in India? Now it is about 183 days, so he will be considered as a resident. Now this is a case study of a non-resident but not ordinary resident. He was a non-resident for so many years. In the year 2021, 22, he has become a resident but not ordinary resident. Another 2 years, he has become resident but not ordinary resident. In the 3rd year, now he becomes a pure resident, because for 2 years, he will get that benefit of R but NOR, because that 9 out of 10 years criteria will apply only for 2 years. After that, he will miss out that 9 out of 10. He will be 8 out of 10, and then naturally, he will be considered as a pure resident. Mr. X stays in various countries during previous year. He does not stay a single day. And I told you this. He is not a resident of any other jurisdiction. He has income of 20 lakhs. Yes, he will be considered but R but NO. Section 6(1)(a). Now, this is the scope of, now what is the scope of total income? Why this particular status is very important? Let's look at first a non-resident. Non-resident, only Indian income is considered. No world, entire outside India. Whatever he earns outside India is not taxable in India. Indian authorities, government have no right to tax any income earned outside India by a non-resident. So they cannot touch that non-resident income. Now, when we go to the pure resident, his entire world income is taxable. That means whatever he earns outside India, anywhere in the world, irrespective of whether it is a business connection in India or whether it is no connection in India. Suppose if he has got some property in USA and he is now a resident in India, but he has, when he was a non-resident, he has acquired some property in USA and is earning some rental income. Now he has settled down in India and his property still continues. He's allowed to hold, as per FEMA, the property or any assets outside India. When he was a non-resident, he's acquired, and he can allow to continue to hold this when he becomes resident in India. He can enjoy that income also. Now that income will be taxable in India because he is now a resident, so their world income will be taxable. Of course, there is a DTAA, we will discuss that in detail. There will be no double tax. If US is taxing it, then India will give them a double tax relief, or either way, we will discuss the mechanism of the double tax avoidance agreement. Now we look at the R but NOR, which is the in-between category. Now R but NOR, Indian income, of course, will be taxable. There is no doubt in debate. Section 9, whatever income accrues or arises in India will be fully taxable. But apart from that, outside India will be taxed only for those businesses which are controlled by India. Now, see, there is a difference, controlled from India. Whereas Section 9 has got some taxability of income which has got a business connection in India. We will discuss that in detail as to what is a business connection. Business connection has been defined very clearly, whereas business controlled in India is not defined. So control means, suppose if there is a subsidiary outside India or there is a branch office outside India and control is in India, the management is in India, and the business is being run at in a foreign country, and the control and management and control is in India, then that income, wherever it is earned, will be taxable in the hands of R but NOR. It will not be in the hands of a non-resident. Non-resident is only Indian income and not any world income, irrespective of control or anything. Now, business control versus business connection, there is a provision, Section 5(1), which talks about business control or in profession set up in India. Whereas Section 9(1)(1), deemed to accrue or arise in India, talks about income which is through a business connection in India. There is a difference. We will quickly discuss as to what is business connection. Has been explained in Mumbai ITAT judgment of Volkswagen Finance, as to Indian company pays to a US company for organizing an event in Dubai. Now see, an Indian company is paying to a US company for organizing an event in Dubai, and that payment to a non-resident celebrity, that is a person who have invited as a celebrity, non-resident celebrity, for doing some marketing or event in UAE, Dubai, for marketing cars in India. Now the cars are marketed in India. So when the cars are marketed in India, connection becomes in India, hell, business connection in India. So since the ultimate aim is to sell cars in India, then it becomes a connection in India. CIT versus RG Agarwal also, in relation to business connection, must be real and intimate, and from which the income must accrue or arise whether directly or indirectly to the non-resident. Now, GKW Industries, Andhra Pradesh, has confirmed this judgment, and the Supreme Court has also confirmed this particular judgment. From various judgments, it can be inferred that the following are the fundamental ingredients of the connection. Continuity, that there is a continuity of the transactions, real and intimate connection. It should not be just a very remote connection. It should be an attribution of income. Common control, there should be a common control. Single transaction would not fall within the ambit of this business connection. There must be some element of continuity in the relationship between the parties, and in every to look at the particular facts of the case to see whether it falls within the ambit of the section. To consider a basis, some continuity of relationship is important. Now, permanent establishment, yes, business connection is there. Suppose I have a PE in a foreign country or in India, the foreign entity has got a PE in India, business connection is established. What is a PE? Maybe a branch office or an office or a go down or something which has got some place of business. Acting as an agent on a foreign country. Now, acting matlab, it should be an exclusive agent. It cannot be a general agent. General agents are not covered. Suppose I'm doing only work for a foreign entity. Yes, I am becoming an agent for that entity, and now the business connection is established. Dependent agent P. That is exactly what I'm trying to say. Services provided in another jurisdiction. Now, one entity provides services in another jurisdiction, another country. Yes, a business connection is established. Construction projects. I'm setting up some projects in another country. Yes, business connection is established. Installing training and supervision. I have supplied some goods and I'm installing and training and supervision. Business connection is established. Affiliate relationships. Intellectual property licensing. Yes, because I am owner of intellectual property and I have licensed it to some foreign country. Yes, business connection is established. E-commerce operation. Nowadays, everybody is doing e-commerce, online transaction. All that also business connection comes into play. There was one equalization levy on those e-commerce connection, and this budget has removed it. I'm not going to discuss that because it is of no meaning. It's a past. But there was very interesting topic of equalization levy. Why they had brought it, we will discuss when DTA comes into. Cross-border investments are also there, where there is a investment made by one company to another company, and then there are some dividends or something accruing, whether it is a business connection, that also is to be seen. Meaning of income or accrue or arise, which is based on the principles of business connection, property in India, assets in India, source in India. So this is the business connection in meaning. Explanation 2.911 is already defined. So this is now download of data as software where aggregate payment exceeds. Now there is a significant economic presence concept has been brought in under explanation 2A to section 911. Now what is that? That suppose if you may not be having any business connection or anything, but now you have downloaded data of aggregate payment of exceeding ₹2 crore, or you have imported goods. Now that person who is supplying goods to one entity in India, and if that services, the goods or services exceeds 2 crore, then that entity is supposed to be having significant economic presence in India, and on that transaction, the income becomes taxable in India. Although it is an import, in import generally you don't pay. The supplier doesn't pay tax in India, but here this is how they have brought in a deeming provision. Share interest in asset located in India. Now, this is very interesting. We all know that famous Vodafone case. What had happened in Vodafone case? The Vodafone company did no transactions in India. They had one company in India. They had one company outside. They had one company outside India, Virgin Islands or some BBC. And that company owned that. There were few layers of subsidiaries, and that company indirectly owned the Indian assets. What this Vodafone did is Vodafone situated outside India did not acquire the Indian assets, did not acquire the Indian shares. They acquired the shares of a foreign company which was holding the Vodafone company in India. Now, indirectly, by acquiring that foreign company, they have got control over the Indian company, and then the income tax department said, no, this particular transaction is taxable in India, and it was a huge amount of transaction, some 30,000 crores of tax was collected from the Vodafone, and that matter went right up to Supreme Court and Appeal High Court. They all gave the decisions against Vodafone, and in Supreme Court, then the decision was reversed, saying that no, there was no provision under the Income Tax Act to tax this particular income. Although, yes, in substance, yes, there is a transaction. There has been a sale of the Indian assets indirectly by acquiring this asset. Now, that was the government realized that there was no provision under the Act, but they did it just as a basis of substance over the form. But then they amended the law. And now there is a specific provision under the Income Tax Act itself that if there is a amount exceeding 10 crores, if there are assets exceeding 10 crores in an Indian company, and it represents 50% of the value of the assets owned by the company. And suppose, for example, if some shares are held, which are basically the company wants to acquire, the foreign company wants to acquire, and through a subsidiary outside India, then if that assets are exceeding 10 crores, then indirect transactions will also be liable to tax in India, and they brought it by way of an amendment to the Act. So this is now the new law which has complied in the Income Tax Act. Now, certain incomes arising or deemed to arise in India, like salary. Suppose, for example, during COVID, many people who were working outside India, they came down to India and they were not able to go out of India. They were stuck because of the travel restrictions. Now, the company out there, they were employees of the US company or foreign company. Now, those companies told them, okay, do one thing. You sit in India, work offline or online. Now, because that time the online working was very much in vogue because COVID taught us how to do online. We are doing a webinar again online. So this was the COVID's realization, and the many employees, they were working in India and rendering service to foreign companies, and they were paying them in dollars. Now, whether that income is accruing in India, yes, the income accrues in India. There are various judgments, which is mentioned here, Pramod Kumar Sapra versus ITO. There is a judgment. Now, why? Now, very basic question as to why that employer is outside India. The person, the salary is paid in dollars outside India. There is nothing. Only thing that person sitting in India is because of the technology, because of their internet, he is able to render service to a foreign company. How the income will arrive in India? Because very simple logic. That person sitting in India, breathing Indian air. So he is enjoying the Indian facilities. So naturally, he has to pay tax in India because the services are being exercised in India. The employment is being exercised from India. And because of that, that income will become taxable in India, irrespective. Now, he is a resident. Naturally, he is staying in India, so he is a resident. So his world income will be taxable. So that income will also be taxable. Certain income arises or demerits. These are the various things like technical services, government payment received from government. Any government is considered as a income from this. Resident, except where used for business outside India. Again, non-resident used for business in India or source in India. Even if the payment has been made from a non-resident to a resident, but if it is used in India, then yes, it will be considered as income accruing in India. In capital gains on sale of property situated in India. If there is a property situated in India, there will be two non-residents selling. But yes, capital gain accrues in India. If there is all transaction happening outside India, but still income accrues in India. Deemed gift. Now, this is a new section being introduced, 918, which says that earlier, resident but not ordinary resident were not part of this, but now they have been included. So there, even that from 1st of April 23, assessment year 24-25, now this new provision has come in. Resident but not ordinary resident will also be covered under a deemed gift. Any amount received from a resident is paying to a resident but not ordinary resident, and it is not exempt under section 56, it will be considered as a deemed gift. So these are the exempt items of the non-resident section 10(4), that is the interest on the bonds and all that. So this I'm not getting into it because it's all very simple. It is given in the paragraphs, so you can go through it at leisure. And I would like, since time is short, I would like to take up those most interesting topics like DTA and 195. So these are all those exempt income of a non-resident, where any income which is accruing because of having a non-resident accounts, then that income is not taxable in India. Then there are special provisions applicable to NRI section 115, which contains definition of a non-resident, investment income, foreign exchange assets, specified, etc., etc. And 115, various provisions are in computing a special rate for non-resident. So interest income, no deduction allowed for actual expenditure incurred, but whatever the entire amount is taxable. For LTCG also no deduction. For only transfer expenses allowable. Indexation is not available to a non-resident. Then there is 115F is the exemption for LTCG for arising on transfer of forex assets. If there are forex assets, then also again there is certain exemptions. 115H is their benefit of under chapter to be availed in certain cases even after the SSC becomes resident. There are certain sunset provisions, like after you have become a resident, you still continue to get this benefit for some years. Now, this is very interesting. Section 48, there is a proviso which says that how do you compute tax capital gains for in respect of only in respect of shares and securities, not for properties. Properties, you don't apply this principle, but for only shares and securities, you can apply this principle of a non-resident out of its foreign exchange. Suppose, for example, a person who has invested several years ago in dollars. Let's say he has put in $1 lakh, and that time the dollar rate was, let's say, 40 lakh rupees or whatever rate was there. So 40 rupees was there. So he has put in 40 lakh rupees in a particular shares or securities. Now, when he is taking it out, he is earning, the sale value, let's say, is today 85 lakh rupees. Now, you will say, oh, 40 lakh invest kiya, 85 lakh sale what, or 45 lakh ke upar tax bhar do. But that is not the case. What is his real income? He had invested $1 lakh, which made it into 40 lakh rupees, because 1 lakh into 40 is 40 lakh rupees. Today, 85 lakh rupees, which he is receiving, if you convert back into dollar, is only $1 lakh. So what he had brought in only is taking it out. He's not made any profit, but you will make him pay tax on 25 lakhs. That is not correct. So the government says you have to reconvert. First, you convert what he has brought in Indian rupees into the currency which he has brought in, which is the dollars, and reconvert whatever in the sale value also in Indian rupees, you convert into dollars, and then now match the dollar and dollar. Whatever is the gain or loss, that you convert back into Indian rupees, and that will be his capital gains, and not the real, the unreal capital gain, which is because of the foreign exchange fluctuation. And he has not, in fact, the NRI might have lost some money. He might not have gained, but he will still end up paying tax if this provision was not there. So this is, I will show you an example of the particular thing. Mr. X, who is a non-resident, has invested 10,000 converted into Indian rupees of 60. Now he sells his shares in for 8 lakh rupees. So exchange rate is 85 rupees. So he has actually that $10,000 what he had brought in is now actually what he is going to take it back is 9,412. So he has lost $588 into now today's rate. That will be his loss, capital loss, and not a gain. So if you now only just apply 8 lakhs versus 6 lakhs, then he will pay 2 lakh rupees per capital gain, which is not right. So that is what this proviso permits you to do that. Tax on long-term capital gain for non-resident in respect of non-resident in case of a long-term capital gain option is to either go for the capital gain as reduced by long-term capital gain. Now here that 12.5% that indexation provisions are not available to non-resident. That amendment which came under section 112(1)(a), it does not apply to non-resident, it applies only to resident. If you refer to 112(1)(a), which and then there is the provision which says that you have got an option whether you apply 20% tax with indexation or 12.5% without indexation. But that is applicable only to resident, and for non-resident, that particular section doesn't apply. 112(1)(c) applies to non-resident, and in that situation, it is flat, say that 12.5%, and there is no question of indexation available to non-resident. Now we go to the residential status under DTA. Now, what is the DTA? First of all, let's understand a double tax avoidance agreement. Now, see what happens is, now certain incomes are taxable, as I mentioned to you, for a resident, world income is taxable. Now, suppose, for example, a person has a house in USA or some capital, some shares in a USA, and or has got some professional fees income from a USA, and he's a resident of India. Now, being resident of India, his world income is taxable, whether it is located in USA or UK or anywhere in the world. But so he'll be taxable in India because of the residential status, wherever accruing. US says, no, this income accrues in USA, so I will not leave it. I will tax it. So now this income, the same income, is getting taxed twice. One, at Indian level because of residential status, and second, because of its accrual. So now, do you mean to say the person has to pay double tax? No. So how does it work out? Now, the countries have come into an agreement, and Section 90 says that yes, these countries have entered into an agreement for avoidance of double tax agreement, and this agreement has got various other aspects also, not just avoidance of tax agreement. It has got exchange of information. For example, Indian government wants to take out some information for a person who is a citizen of India who is now staying in USA, and he has done some problem and he has got some tax evasion. they can ask the US government to provide information about his local taxes or local income in USA under this DTA, and the US government is obliged, required to give information. And that is the reason how this government also gets a lot of information from outside India, like Switzerland or other countries, and they are in a position to issue notices to the local persons over there. Okay, but you have done something in US, or you have got some investments in US, and you have got this information is through this sharing, information sharing. So the tax sharing, tax aspects is one aspect of the DTA, but this is the main aspect. Now, what does it say? Now, for example, US, let's say the tax rate is 28%. Okay. I mean, there are various slabs and various deductions allowed and all that. I'm not getting into that, but assuming that the rate is effective rate is 28%. Now, in India, sometimes the rate is either 33%, or in some cases it could be 14%, it could be 20% also. So different rates are applicable in India. And effective rate might be slightly lower also, because you have got a slab rate. So let's say now in companies it got 26%, whereas in the LLP you got a 30 ke upar jata hai. But if it is an Indian resident, he might have a lower tax also, or it might be higher also because of the surcharge. So now we have to work out what is the effective rate at both the countries. Now, let's say a particular income is taxed in India at, let's say, 33% because of its slab and surcharge and all that. The same income, which is being taxed at 33% in India, is taxed in USA at 28%. So how does DTA work? Now, that 33% tax which he paid in India, he will be in a position to utilize that tax set off in USA. Suppose now the USA, there is a withholding tax, and at least 28% has been paid by him. Suppose USA has collected 28% under the withholding tax. So now that withholding tax credit, he will be able to set off in India, and 33 minus 28, he will only pay 5%. So 5% tax he will pay in India, and not entire 33%. So effectively he pays 33%, but he doesn't pay double. He pays 28% in USA, he pays 5% in India. So this is how the taxation works. So double tax, he gets a credit for wherever the tax has been paid, and wherever there is a higher tax, he has to pay the differential amount. So this is how the double tax avoidance agreement works. Now, this DTA, you have to determine the residential status of in both the countries where he is the resident. So now there are, first is a permanent home. Yes, then it becomes, suppose if he has got a permanent home in both the places, then you go to the next criteria. There are about 5 criteria. Center of vital interest closer, which is where he has got a more economic vital interest. Now there, if he has got in both or none, then the second criteria is satisfied. Now you go to the third, habitual abode, where he stays generally, where he goes and stays, maybe in a residential house, but where he spends more his time. So where he has got an habitual abode. So in that country, suppose if he is in both, then again you go to the fourth one, that is the national. If he's a national of which country, is he the US citizen or is he an Indian citizen? That also will determine his. Then ultimately, I mean, fourth item is citizenship. And the fifth item, suppose if he is a citizen of both the countries, now you've got a dual citizen. Or he is not a citizen of any of the countries, citizen of UK. But here we are talking about DTA between India and US. So this is none. So now none of these conditions are complied. So now we have to go to the competent authority of both the countries. They will decide who is where is the resident. So suppose if he meets conditions at any one stage, then he becomes resident of that country. Now we go to the very interesting section of section 195. And we will quickly complete because there are very interesting sections, very interesting points on section 195. Now, any person making a payment to a non-resident, section 195 applies, and we have to deduct tax as per either the Income Tax Act or the DTA, whichever is beneficial to that person. So whichever is beneficial. So if that DTA says lower rate, we apply lower rate. If there is if the income tax it gives you lower rate, apply the lower rate. So that benefit goes to the assessee, and so you have to apply that rate. Now, DTA, what is basically DTA is the sharing of revenue between the two countries. They will decide, okay, 20 or 30% ka tax hai, 50, 10% hum lete hai, 20% aap le lo. So that is how the sharing happens. So 10 and 20, this is how the sharing, and the sharing is given in DTA. In some cases, 20% is taken by the one country, the 10% is kept by other country. This is how they share, and that is agreed by between the two countries. So we have to honor that agreement. So nature of income is interest, royalties, fees for technical service. All this is defined in this, and there are this DTA format is standard format. There are some standard formats which has been followed by various countries, and dividend, capital gains, and other, everything has been defined. And based on that, what is the taxability, where it is taxed, it is already defined. So compliance and reporting, you require a TRC to do certain where he is the resident. Okay. And another thing is that whether it is a P, because if there is a business income involved, PE comes into picture. The taxability comes in where there is a P. If there is no P in another country, then taxable in the other country. All payments made to non-resident section 195, except for imports, TDS is applicable, because the section of 195 is a very wide section. It's any payment to a non-resident. So even payment for shares, purchase of properties, anything, capital gains, everything is taxable except for import of goods. Now, import of goods also, as I told you, if there's significant influence, yes, then economic influence, then yes, it is applicable. DTA to be checked, section 90, you have to check. Apply rate as per DTA or income tax, whichever is beneficial. Now, this is a very interesting concept, make available concept under DTA. Now, I'll explain you what is a make available concept. Now, suppose in Singapore, let's say DTA with Singapore, India. There is one architect sitting in Singapore, and there is a developer sitting in India who wants to develop a project. Now, for the project, he wants plans or drawings to be made by an architect. He's hiring an architect of Singapore to make his plans and drawings for this particular project, how this project will look and how his project will work. So that architect sitting in Singapore, he makes certain drawings, plans, and sends it out on internet or through mobile, through your emails. He will send out all these drawings and plans. Now, as far as DTA between India and Singapore is concerned, it is a technical service because it is a technical aspect. The architect is a technical service. Now, there is one provision. If the architect is giving you a make available technology of whatever he's providing service, then that will be taxable in India. And if he's not make available, then the taxability is in Singapore. Now, what is the meaning of make available? Like, for example, the architect has made drawings and send it for a project A for this builder, and he has sent it to the builder. Now, builder can utilize this particular drawings and make that project. Okay, fine. But suppose if that builder wants to do a project B, he doesn't know how this architect has made the drawings for this project A. So he cannot make another drawings for project B. He will again have to go back to the architect saying that please send me the drawings or make drawings for my project B. He has got no technology to make again the drawings for project B. He has got not been trained how to make the drawings. He has been given the drawings. So then technology, there is no make available concept. He has not given that technology, he has not make available that method of making that drawings. So in that situation, the taxability will be in Singapore and not in India, unless he gives that training also. Okay, aapko kaise banana hai? You make the drawing. See how you have to make the drawing. Now he has taught him how to make the drawing. Now henceforth he doesn't have to go to that architect. He can straight away make another drawings for other projects, and then it is a make available concept. Then taxability will be in India and not in Singapore. So this is the very thin concept. And now why this is required? Because Section 9 is taxing income arising in India. And again, when there is a payment being made to a non-resident under 195 and there is a TDS to be deducted, a chartered accountant, we as a member of the institute are required to fill up one form 15 CB, which is an auditor's certificate, a chartered accountant certificate certifying what is the quantum of tax to be deducted. 15 CA is to be prepared by the company or the entity, but 15 CB is to be uploaded by the chartered accountant. And when he does that, he has to evaluate this DTA, he has to evaluate the Income Tax Act, which are the sections applicable, which are the rates applicable in force, what is the type of services rendered, he has to see the contract, he has to make all the documentation to ensure that it is compliant with the this Income Tax Act. And then DTA also he has to understand the DTA concept, make proper documentation, make proper paperwork, because it is a certification. And tomorrow, if that certification is proved wrong, he can be also questioned, and authorities can pursue him for for giving the wrong certificate, and he can be taken to the disciplinary committee. So this is very important. When you are certifying 15 CB, you should be very clear what is the provisions of DTA and the Income Tax Act in respect of 195. Now, payment of imports, I have already explained to you, significant economic presence. Import of more than 2 crore, TDS is applicable. Now, how do you compute? There is one very interesting section 195(2) says, okay, when you cannot compute, see, for example, a person is, let's say, a non-resident is selling his house to a resident. Now, suppose, for example, he's selling for 5 crores. Now, naturally, there might be a cost of when he's purchased the flat, there is a cost. And there could be, earlier there was indexation. Now the indexation options are available to a resident, not to a non-resident. So he might have a cost, and now that he can claim that deduction, and he can show that lower income, which is the actual capital gain, and on that he has to pay the tax on that. But the buyer who is there, he doesn't know what is the cost. He's not supposed to know which is the cost. Now he will deduct tax on the entire sale value, what he is paying to the non-resident seller, and he will deduct 14% or whatever now the rate applicable. He will deduct that full tax. Now this non-resident person will have to file his return, claim that differential refund in his return, because that entire amount is not this capital gain. It is only the small portion of capital on which the tax is applicable. But then the person who is the buyer is not supposed to know. Now, how he can know? Yes, the non-resident seller should go to the income tax department, income tax officer with relevant income tax officer, international tax division, and he has to obtain a lower deduction certificate under section 197. And once he gets the certificate, the income tax officer will then compute, because he has got all the purchase. He will ask for all the purchase documents, everything will verify. It will be like an assessment. He will compute the tax and he will say, okay, now deduct tax only at this much percentage on the entire sale value, which is the equivalent to his actual tax on the capital gain. And now the buyer will be allowed to deduct tax on that amount. I think I understand, Piyush, the time is up, and I'll just 2 minutes, I'll wind up, and then you can take it over. Now, there is one thing is sum chargeable to tax. What is sum chargeable to tax is discussed in the GE Indian Technology Center, and this judgment of Supreme Court, which says that in case if you cannot determine the tax, it has to be on the gross value, and the determination only of the capital gain can be done by the income tax officer. These are the rates of income tax which is applicable to various types of income. I'm not getting into it because it is available in your ready reckoner. Lower deduction certificate, I told you, I've already explained this. Concept of grossing up. Suppose sometimes you agree on the tax being borne by the pay person who is paying the money. So the whatever amount is being paid is, suppose if the tax rate is 10%, so whatever is being paid is 90%. So you have to gross up. So actually you have end up paying 11% tax instead of 10% tax. So these are all this 15 CB I've already explained. Process for filing is that first 15 CV has to be obtained. First, it has to be uploaded. Then once it gets approved by the income tax department, then 15 CA has to be uploaded. And 15 CA also takes up a lot of data from 15 CB. And then once it is uploaded, then you do a DSC, and then approval takes about 3 to 4 hours. Earlier, approval was not required. Now the income tax department approves this particular forms. Now, PAN requirement for 206AA, if there is no PAN, 20% deduction. That exemption is given to a non-resident. But if you're furnished in or functional equivalent. Now, tax residency certificate can be obtained in form number 10F. That is also there. Now, schedule. Now, this is the last one, and I'll end. Schedule FA of ITR. All residents are required, not R but NOR, but all pure residents are required to disclose in their schedule in the income tax return a schedule FA, which is a fixed assets and liabilities. You have to disclose all the assets, foreign assets of their whatever assets they are having outside India. Now it could be a foreign depository custodial account, investment in foreign equity debt, any movable property, other capital asset. Even if they are only a signing authority in any account, if suppose there is a company and they are only signing authority in that account, they will have to disclose that account. The peak balance has to be disclosed, and non-disclosure will entail a penalty of 10 lakh rupees per return. And if there is an income on that and it is not disclosed, then there is a prosecution. This is the format which is there for the disclosure. So I think with this, I come to an end to my presentation. I hope I have done justice to it, and I would now request the moderator to take over, and if there are any questions, Piyush, I can answer.
Yeah, definitely. We will go for the question and answer, but I must thank you for this beautiful enlightening session on the DTAA. But to inform you all, we have got around 900 plus 905 viewer for this webinar. It's a really beautiful number. Let's start with the Q&A now. So we have got certain questions on the Q&A portal. Let me start one by one. So Anurag Maheshwari from Saharanpur, please suggest about the taxability of exempted income generated in India for NRI.
See, as far as the NRI tax exempt income is interest on NRE deposit, that is not taxable. So it is exempt, section 10. So there is no question of any TDS. No, there is no TDS on the NRE interest deposit. So wherever there is an exempt income, then there is no question of any TDS. Section 10, if it is part of section 10.
Okay. Next question is from Hemant Pehwa from New Delhi. So he's asking about import of goods from a USA agent. So will TDS be deducted
Yes,
on
as
the
I mentioned
payment?
to you, if there is a exceeding 2 crores
2 crores.
in one financial year, yes, you have to apply that. What is the rate? That rate is not defined, but there is some profit, whatever it is, you have to work out, and then so it's very difficult situation because how they will not even share the data. So you might go by
Right.
correct.
Right.
So you have to deduct tax on that.
Arun Kishore is asking how to check if someone has filed Form 10F.
It is an online form, and we have to that we get a certificate. We get a certificate after 10F. So once you file, then you get a certificate of this.
Next question is from Ganesh Panchal from Pune. He is asking that one Indian citizen is now the permanently resident of Australia.
Yeah.
Now he wants to transfer his Indian saving to the USA. So will there be any taxability in this?
No. I'll explain you. See, here we are mixing of FEMA and income tax. As far as FEMA is concerned, a non-resident can do any transactions outside India, foreign transactions. Indian government has got no connection with it. Okay. So if he is transferring his an Australian who's staying in India, outside India in Australia, and I assume he is the non-resident, and he is also non-resident for FEMA purposes. And so he is transferring his funds outside India, I mean, from Australia to USA. Indian government has got no business in it, and is not taxable for any income in India.
Okay, sir. Next question is from Nagarjan from Tanjore. He's asking that a private limited company selling through Amazon USA platform, Amazon is incurring certain expenses in taking reimbursement. So, will there be any taxability on the payment, or TDS need to be deducted?
Yeah, very interesting question. This was equalization levy, which was levied earlier. This has been withdrawn. Now they are coming out with some taxation on those Amazon and those these things separately. That is another aspect. But I will explain you this why equalization levy. I mentioned earlier that I wanted to explain you why equalization levy. You see, in DTA, they have discussed about sharing of income tax. Now, Indian government did not wanted to share some tax. So they said they gave it a name of equalization levy, which is not defined under the DTA. So if there is an equalization levy collected in India, they did not share with the foreign counterparts. So that was the reason, but now that has been abolished from assessment year 24-20.
Okay. Next question is from Janardhan from London. One of my clients who recently became UK resident has sold his flat in April 24. This property was purchased in 2011. As there was no LTCG after indexation, the sale proceeds lie in his NRO account. If he remits the money to his bank account in UK, does he need to deduct TCS on his remittance?
Yes, very interesting. Let me just, I'll take 2 minutes, but I'll explain you the difference between NRO and NRE. NRO account is like, suppose when we go abroad, we cross immigration. So NRO account is something account which is before immigration. And NRE account is account after immigration. That means any money in the NRE account is freely repatriable, no questions asked. No immigration officer is going to question you why the money is going out. So no bank will ask you where the money is going. Whereas NRO, yes, any money going out of NRO account has to be 15CA, 15CB, because 15CA, 15CB is a tax. So anything which goes outside NRO account, you have to comply with the 15CA, 15CB, and as well as other provisions relating to FEMA, whether it can be repatriated. So those things are applicable. So you have to clear that immigration, which I mean by tax. You have to clear the tax, otherwise you cannot transfer money out of India. Whereas NRE, any money in NRE first comes is tax paid. Then only it can go into NRE account. And once it comes there, then it is freely repatriable. No question asked. So this is the difference.
Okay, sir. Next question is from Meenakshi Chauhan from Dehradun. They are asking for foreign remittance toward the license inbuilt in the hardware. Can it be considered as goods instead of service for TDS?
Very interesting question. Yes, if it is inbuilt into, like, for example, when you buy a computer, you get Microsoft packages as a part of the software, so it becomes part of the hardware. But if you take a separate license, then yes, then it becomes a taxable. So it becomes part of the hardware, because without that the hardware cannot work.
So do we need to check whether major part is hardware or major part is software? Like if we are importing software in the pen drive.
Yeah, there's a substantial part is the hardware, and software, of course, runs the hardware. Without that, hardware is not used. But still, it is ingrained into the hardware.
So next we have Madhusudan from Madurai. They are asking, an engineering company supplies civil drawing to the company in USA. The income earned is taxable in India. For this drawing in a certification is required in USA from a USA engineer. This Indian company pays fees to the USA based engineer. So whether TDS is to be made on payment made by the Indian company to the certifying USA person?
100%. Yes. Now you again look at DTA. Again, as I mentioned, you make available is there in US also. So that you have to see. Taxable in USA or in India. DTA you have to apply.
So we have got a lot of questions, but we are running short of time. So I'll take last question now from Shubham Gupta from New Delhi. They are asking whether we have to deduct TDS on the purchase of fixed assets exceeding 50 lakhs from the foreign party.
Sorry. Can you repeat the question? I missed the wording.
Whether we need to deduct TDS on purchase of fixed assets exceeding 50 lakh from foreign party.
See, first of all, that 50 lakh limit applies only to resident. We have got those section 194 ALA and all that. That is only applicable to resident. 50 lakh limit is applicable to resident. For 195, 1 rupee is also a limit. There is no limit. Any payment outside India has to be considered. So if you are buying any property from a non-resident, yes, TDS is applicable.
Okay, that's it. We should wind up this session. This was really a beautiful session, sir. Thank you. On behalf of the CP Committee of ICAI, I would like to extend our sincere gratitude to each and every one of you from the participation and valuable contribution to today's webinar on non-resident taxation remittance with a special focus to Section 195 and TTAA. We are immensely grateful to our esteemed speaker, CA Kusai Goala sir, for sharing his expertise and insight on this crucial topic. Your perspective have provided us with the valuable guidance on how professional can navigate the complexities of non-resident taxation and remittance. I would also like to thank all our attendees for your active engagement, asking the questions and thoughtful questions. Your participation has enriched our discussion and made this webinar a truly interactive and informative session. A special thanks to the technical support team also. Thank you once again, Kushai sir, and everyone participating for this session. Now we shall start with the next session. Thank you so much, everyone. So next section, we will start with the corporate governance.
So I will take your lead, sir.
Yeah, thank you so much, sir. Yeah. So hello, everyone. Once again, I am your host for today's webinar, Piyush Sinha. I'll moderate your session on corporate governance, stakeholder perspective. For this, we have CA Rakesh Chaudhary sir from Ghaziabad. He'll take your session on the corporate governance. He is a chartered accountant in practice since 1991 in the area of audit, financial reporting, corporate governance, sustainability reporting, income tax, GST, corporate laws, social impact assessment, peer review, technical review, and tax audit quality review, etc. He has published papers and article in the journal, newsletter, and souvenir of the Institute of Chartered Accountant of India, newsletter, National Cost and Management Accountant Convention, Tax Bulletin, etc. So he'll help us understand the nuances of corporate governance from the stakeholders' perspective. And now I'll hand over this session to CA Rakesh Chaudhary, sir. Over to you, sir. Sir, you are on mute.
Thank you, PUC. Namaskar to all the members participating in the session.
Yes, sir.
Thank you, Namaskar. And thanks to the CP committee of the Institute of Chartered Accountants of India for giving me an opportunity to give a session on corporate governance, which is a very interesting area for all the corporates. Can I share the PPT?
Yes, sir. Please present your screen, sir.
Yeah, please. Just a second. Is it remote control from there? Can somebody from the technical side help sharing the screen?
Hello, Akash is there?
Sandeep,
can you help him share the?
Can you please help me for the sharing of the PPT? Okay. No, I'm not able to move the cursor. Wait, the cursor is not moving. Is it remote control?
Can you press F5, sir? F5?
No, its cursor is not moving. Once more, can you move the screen inside? Thank you. I would like to introduce corporate governance to all the participants. Corporate governance is the governance from stakeholders' perspective of the corporate values, corporate board, corporate management, corporate code of conduct, corporate policies, corporate standards, corporate reporting, corporate affairs, corporate internal control systems, corporate sustainability, corporate strategy, corporate efficiency, corporate growth, corporate employees, corporate investors, corporate supply chain management, corporate goals, corporate social impact, the corporate resources, corporate digitization, corporate artificial intelligence, corporate data centers, corporate goods, corporate product, corporate social responsibility, corporate culture, corporate practices, corporate compliances, corporate performances, corporate consumer, corporate customers, corporate shareholders, corporate reviews, and corporate activism for all the stakeholders in the national economic development. Now, I would like to introduce you the Securities and Exchange Board of India Listing Obligations and Disclosure Requirements Regulation 2015 as amended. Regulation 4.1, Chapter 2, Principles Governing Disclosures and Obligations of Listed Entities. From stakeholders' perspective, corporate governance, what the stakeholders require, the disclosures and obligations by the listed companies, what they are expecting, that is being dealt with in Regulation 4.1. The listed companies has to make disclosures and abide by these obligations. The financial information which will be prepared and disclosed in according to the applicable standards of accounting and financial disclosures. Implement the prescribed accounting standards in letter and spirit in the preparation of financial statements, taking into consideration the interest of the stakeholders, and also to ensure the annual audit is conducted by an independent, competent, and qualified auditor. The listed entity has to refrain from misrepresentation, ensure the information provided is recognized, stock exchange and investors not misleading. The listed company also has to provide adequate and timely information to recognize stock exchange and investors. They have to ensure and disseminate the provisions of the regulations and circulars. They are adequate, accurate, explicit, timely, and presented in a simple manner and simple language. The listed company has to disseminate enough information from various channels, providing equal, timely, and cost-efficient access to relevant information by the investors. The listed company also has to abide by all the provisions of the applicable laws, of security laws, and other guidelines issued by the board, and as well as stock exchange, and as well as Institute of Chartered Accountants of India and other regulatory bodies. The listed entity has to make specified disclosures following its obligations in letter spirit, taking into consideration the interest of the stakeholders. The filings, reports, statements, documents, information are event-based or filed periodically, shall contain relevant information and has to be filed as per events occurring in the corporate. The periodic filings, reports, statements, documents, and information reports are contain information that shall enable investors to track the performance of a listed entity at regular intervals of time and shall provide sufficient information to enable investors to assess the current status of listed entity. Regulation 4.2 it contains the principles governing disclosure and obligations of listed entities, which are the rights of the shareholders. The information has to be very timely, equitable treatment to all the shareholders has to be done. The role of stakeholders in corporate governance, they have to comply. The disclosures and transparency with the listed company has to comply, and the responsibility of the board of directors. The listed company, the rights of shareholders has to protect and facilitate the exercise of the following rights of shareholders: right to participate in and sufficiently inform the fundamental corporate changes, the opportunity to participate and vote in general shareholders meetings, be informed of the rules, voting procedures that govern general shareholders meetings, the opportunity to ask questions to the board of directors, to place items on agenda of general meetings and to propose resolutions subject to certain limitations. These are all the rights of shareholders. The effective shareholder participation is required for key corporate governance decisions, for nomination and election of members of the boards of directors, exercise ownership rights by all the shareholders, including institutional investors, adequate mechanism to address the grievances of the shareholders. That these are the basic rights of the shareholders: to protect the minority shareholders from abusive actions by and or the interest of controlling shareholders acting either directly or indirectly in effective means of addressing it. It has to provide timely information adequately and timely, but not limited to the following: sufficient and timely information concerning the date, location, and agenda of general meetings, as well as the full and timely information regarding the issues to be discussed at the meeting. Capital structure and arrangements to obtain degree of controls disproportionate to their equity ownership. Rights attached to all series and classes of shares. This shall be disclosed to the investors before they acquire shares. The equitable treatment of all the shareholders, including minority and foreign shareholders, they should be done in the same series of class, treated equally in the same manner. The effective shareholder participation in key corporate governance decisions are required for nomination, voting rights, the framework to avoid insider trading and abusive self-dealing, the processes and procedures for general shareholders meetings shall allow for equitable treatment of all shareholders. The procedures for listed entities will not make it unduly difficult or expensive to cast votes. The role of stakeholders in corporate governance. The listed entities shall recognize the rights of the shareholders and encourage cooperation between the listed entity and the stakeholders. The listed entity has to respect the rights of the stakeholders that are established by law or through mutual agreements. Shall have the opportunity to obtain effective redress for violation of their rights. Access to relevant, sufficient, and reliable information on a timely and regular basis to enable them participating in corporate governance process. It shall devise an effective vigil mechanism and whistleblower policy enabling shareholders, stakeholders, including individual employees and their representative bodies, to freely communicate their concerns about illegal or unethical practices. It shall disclose and maintain disclosure and transparency policy for timely and accurate disclosures on all material matters of financial situation, performance, ownership, and governance of the listed entity. Information shall be prepared and disclosed in according with the prescribed accounting standards, financial and non-financial disclosures, and the listing agreement. Channels for dissemination of information has to be equal and timely and cost efficient. Access has to be there. Minutes of the meetings that explicitly record all the dissenting opinions of all the stakeholders. Next, we come to the responsibilities of the board of directors. What are the responsibilities? The disclosure of information, material interest in any transaction matter directly affecting the listed entities, they have to disclose. The board of directors shall conduct themselves according to the code of conduct policy given by the company as to meet the expectations of the operational transparency to stakeholders while at the same time maintaining confidentiality of information in order to foster a culture of good decision making. The key functions of board of directors: reviewing and guiding corporate strategy, plans of actions, risk policy, annual budgets and business plans, setting for performance objectives, monitoring implementation and corporate performance, and overseeing major capital expenditures, acquisitions, and divestments. Monitoring the effectiveness of the listed entities' governing practices and making changes as needed, selecting, compensating, monitoring, and when necessary, replacing key managerial personnel and overseeing succession planning, aligning key managerial personnel and remuneration of the board of directors with long-term interest, transparent nomination process with diversity of thought, experience, knowledge, perspective generated in board of directors, monitoring and managing potential conflict of interest of management members of the board of directors, misuse of any corporate assets and abuse in related party transactions, all have to be disclosed, and these are the key functions of the board of directors. The integrity of the listed entities' accounting and financial reporting systems, including the independent audit and appropriate system of control, internal control system, risk management, financial and operational control and compliances, any misuse of corporate assets and abuse in related party transactions, overseeing the process of disclosure and communications, monitoring and reviewing board of directors evaluation framework. The other responsibilities of the listed company is to provide strategic guidance, effective monitoring of the management, and which shall be accountable by the stakeholders, listed entities, and the other government authorities. Will set a corporate culture and values, act in a fully informed basis in good faith and due diligence and care in the best interest of the listed entity. The board of directors shall encourage continuous directors training kept up to date, treat all shareholders fairly, high ethical standards, and shall take into account the interest of stakeholders. The board of directors shall exercise objective, independent judgment on corporate affairs, assigning a different number of non-executive members, independent judgment to tasks where there is a potential for conflict of interest. Rightly encouraging positive thinking, these do not result in over-optimism that either leads to significant risk not being recognized or exposes the listed entity to excessive risk. The board of directors shall have the ability to step back to assist the executive management by challenging the assumptions underlying strategic initiatives such as acquisition, mergers, risk appetites, exposures, and key areas in the entity's focus. Mandate, composition, and working procedures committees are deciding shall be well defined and disclosed by the board of directors. Members shall be able to commit themselves effectively to their responsibilities. In order to fulfill their responsibilities, shall have access to accurate, relevant, and timely information. It shall facilitate the independent directors perform their role effectively in the board. Next, we come to the main information which the board of directors have to place and furnish in corporate governance as per Schedule 2 and Regulation 17.7. Annual operating plans, budgets, and updates, they have to provide the information which have to be provided before the board of directors. Annual operating plans and budgets and updates, capital budgets, quarterly results, minutes of the meetings, recruitment and remuneration of all the directors and management, so-called demand prosecution notices and penalty notices which are material, fatal and serious accidents, material defaults in financial obligations for public or product liabilities of substantial natures, joint ventures and collaboration agreement, substantial payment towards goodwill, brand equity or intellectual property, labor problems, significant labor problems, human resource and industrial relations front, wage agreement, implementation of voluntary retirement scheme, sale of investment subsidies, assets which are material in nature and not in normal course of business, quarterly details of foreign exchange exposures kept by the management, risk of adverse exchange rate movement, non-compliance of any regulatory, statutory or listing requirements, shareholder services for non-payment of any dividend or delay in any share transfer. Next, we come to the compliance certificate, which has to be disclosed and presented before the board of directors in the meeting in corporate governance as per Regulation 17.8 of the SEBI Listing Obligations and Disclosure Requirements Regulations 2015 as amended. They have to furnish the reviewed financial statements and cash flow statement which do not contain any material untrue statement or omit any material fact or contain statements, a true and fair view of the listed entities' affairs, no transactions entered into by the listed entity which are fraudulent, illegal, or violative of the entity's code of conduct, accept responsibility for establishing and maintaining internal controls for financial reporting, and they have evaluated the effectiveness of internal control systems of the listed entity pertaining to financial reporting, and they have to disclose the auditors and the audit committee deficiencies in the design or operation of such internal controls. Of their various steps they have to taken or propose to take to rectify these deficiencies. They will all indicate to the auditors and the audit committee any significant change in the internal control over financial reporting and the accounting policies and notes to the financial statements which has to be disclosed them, the significant frauds and the awareness and the involvement therein, the internal control system over financial reporting. Next, Part C contains the role of audit committee and review of information by audit committee as per Regulation 18, Subpart 3. The role of audit committee oversight of the entire financial reporting process and the disclosure of financial information. The financial statement is correct, sufficient, and credible or not. Recommendation for appointment, remuneration, and terms of appointments of auditors of the listed company. Approval of payment to statutory auditors for other services by the statutory auditors. Reviewing the management annual financial statements and auditors report. Matters in director's responsibility statement as per section 134(3) of the Companies Act. Changes in accounting policies and practices, accounting entries involving estimates based on the exercise of judgment by management, significant adjustment made in the financial statements arising out of audit findings, compliance with the listing and other legal requirements, disclosure of related party transactions, any modifications in the draft audit report, reviewing with management the quarterly financial statement before submission to the board, reviewing with the management the uses and application of funds in public issues, rights issue, preferential issues. Next, we come to the reviewing and monitoring of auditors' independence and performance effectiveness of audit process, approval of subsequent modification of transactions of listed entities, scrutiny of intercorporate loans and investments, valuation of undertaking or assets, internal financial controls and risk management, performance of statutory internal auditors, internal audit functions, department staffing, seniority of internal auditors of any significant findings, internal investigations, the statutory auditors' discussions and analysis, substantial defaults in payments, in payment of depositors, debenture holders, in case of declared dividends and non-payment of dividends and creditors, to review the functioning of the whistleblower mechanism, the appointment of the CFOs, Chief Financial Officer, assessing the qualification experience and background, carrying out any functions as mentioned in terms of reference of the audit committee. Next, part C, we come up to the regulation 8 part, regulation 18 subpart 3. Audit committee shall mandatory review the management discussion and analysis of financial condition and results of operations, management letters of internal control weaknesses issued by the statutory auditors, internal audit reports for internal control weaknesses. These are all mandatory provisions. The appointment, renewal, and terms of remuneration of chief internal auditor to be reviewed by the audit committee, statement of any deviations, quarterly statement of any deviations, report of the monitoring agencies, which has to be submitted to the stock exchange as per regulation 32, subpart 1. Annual statement of funds utilized for purposes other than those stated in the offer document, prospectus, or notices in terms of regulation 32, subpart 7. Part D of the regulation 19 subpart 4, 20 subpart 4, and 21 subpart 4 of SEBI listing obligations and disclosure requirements regulations 2015 require the role of nomination and remuneration committee, the formulation which deals with the formulation of the criteria for determining the qualifications, positive attributes, and independence of the directors, and recommend to the board of directors a policy relating to the remuneration of the directors, key management personnel, and the employees. For every appointment of an independent director, the nomination and remuneration committee shall evaluate the balance of skills, knowledge, and experience on the board. On the basis of such evaluation, prepares description of the role and capabilities of the independent director. Terms of appointment are given to the independent director. For the purpose of identifying, the committee may use the services of an external agency, consider backgrounds having due regard to diversity, consider time commitments of the candidates, formulate the criteria for evaluation of performance of independent directors, devise a policy on diversity of board of directors, identify persons who are qualified to become directors who may be appointed in senior management, all in the directors' policies, appointment of the directors' policies, and the removal of the directors, whether to extend or continue the term of appointment of independent director on the basis of the report of performance evaluation of the independent directors, and recommend to the board all remuneration in whatever form payable to senior management. Next is the stakeholders relationship committee. The role of the committee is resolving the grievances of the security holders of the state entity, including complaints relating to the transmission of shares, non-receipt for annual report, non-receipt for declared dividends, issue of new duplicate certificate general meetings, review the measures for effective exercise of the voting rights by shareholders, review of adherence to the service standards adopted by the listed entity in respect of various services being rendered by registrar and share transfer agent, review the measures and initiative by the listed entity for reducing the quantum of unclaimed dividends and ensuring timely receipt of dividend warrants, annual reports, statutory notices by the shareholders of the company. The risk management committee, the role is to formulate a detailed risk management policy for identification of internal and external risks specifically faced by the listed entity, which includes the financial, operational, sectoral, sustainability, ESG reporting, BRSR reporting, information, cyber security risk, or other risks as may be determined by the committee. Risk mitigation, including systems of procedures and processes for the internal control of identified The business continuity plan policy is devised to ensure the appropriate methodology, process, and systems are in place to monitor and evaluate risk according to the business associated with the business of the company. To monitor and oversee implementation of risk management policy, including evaluating the adequacy of risk management systems, risk management policy at least once in 2 years, including changing industry dynamics and involving complexity. Keep the board of directors informed about the nature and content of its discussions, recommendations, and actions to be taken. The appointment, removal, and terms of remuneration of the chief risk officer shall be subject to review by the risk management committee. It will coordinate its activities with other committees overlapping with activities of with such committees as per the framework laid down by the board of directors. Part E, discretionary requirements are required as per Regulation 27(1) of the SEBI LODR Regulations 2015. The board, a non-executive chairperson, may be entitled to maintain a chairperson's office at the listed entity's expenses and also allowed reimbursement of expenses incurred in performance of his duties. The listed entities ranked from 1001 to 2000 as per list prepared by recognized stock exchange in terms of sub-regulation 2 of regulation 3 shall endeavor to have at least one woman independent director on its board of directors. It has changed to 2000 members also. 2000, the listed entities which are ranking 2000 from 1 to 2000. The shareholders' rights, the half-yearly declaration of financial performance, including summary of the significant events in last 6 months, may be sent to each shareholders. Modified opinion listed entity may move towards a regime of financial statements with unmodified audit opinion. Separate post of chairperson and the managing director or the chief executive officer may appoint separate persons to each of the posts of chairperson, MDs, chief executive officer. Chairperson shall be non-executive director and shall not be related to managing director or chief executive officer as per the definition of relative defined under Companies Act. And the internal auditor may report directly to the audit committee. Next, we move to Schedule 5 of the annual report under Regulation 34(3) and 53(f) of the SEBI listing obligation disclosure requirements regulations 2015 as amended, which contains disclosures of corporate governance reporting as per Schedule 5, Part C. A brief statement, the disclosures which the listed entity has to give on corporate governance in the annual report. The listed entity's philosophy on code of governance. A brief statement has to be stated by the chairman and the board of directors. Composition and category of directors, promoters, executive, non-executive, independent, non-executive, nominee directors, institution representative, whether as lender or as equity investor. Attendance of each director at the meeting and the last annual general meeting. Number of other board of directors or committees in which a director, the directors are members or chairperson, including separately the names of the listed entity where person is a director and the category of directorship. The number of directorship with each company it has to state. The number of meetings of the board of directors held and dates on which it is held. The disclosure of relationship between the directors interest has to be disclosed. Number of shares and convertible instruments held by the non-executive directors. Web link where details of familiarization programs imparted to independent directors is disclosed. A chart or a matrix setting out the skills, expertise, and competence of the board of directors specifying the following. The list of core skills, expertise, competencies identified by the board of directors as required in the context of its businesses or sector for it to function effectively and actually available to the board. The names of directors with such skills, expertise, and competence. Confirmation opinion. In the opinion of the board, the independent directors fulfill the conditions as per the regulation and independent of the management. Detailed reasons for any resignation of any independent director who resigns. Part 3 contains the audit committees, the disclosures which has to be given in the annual report by the audit committee, brief description of the terms of reference, composition of number of members, chairperson, meetings and attendance, nomination and remuneration committee, brief description, references, composition, meeting, attendance, performance evaluation, stakeholders relationship committee, same name of the entities, name designation and shareholders complaints, not solved in satisfaction of the shareholders, number of complaints, number of pending complaints, with the risk management committee in description of the references, composition, meetings and attendance, the senior management changes which are required in previous financial year, remuneration of directors, all pecuniary relationship or transaction or non-executive directors, criteria for making payments to non-executive, all have to be disclosed in the annual reports. Alternatively, they must be disseminated on the listed entities website, reference drawn thereto in the annual report. Disclosures with respect to remuneration in the Companies Act, all elements of remuneration package summarized with major groups, salary, benefits, bonuses, stock option, pension, etc. Details of fixed component of performance like incentives and performance criteria, service contracts, notice periods, severance fees, stock options, general body meetings, location and time, 3 annual general meetings, special resolution, previous 3 annual general meetings, special resolution passed, so postal ballot, details of voting pattern, person who conducted the postal ballot exercise, whether any special resolution is proposed to be conducted through postal ballot, procedures for postal ballot, the means of communication as through quarterly results, newspapers, the websites, and official news releases. The general shareholders information has to be provided by part in clause 9. Annual general meeting date, time, venue, financial and dividend payments, name and address of stock exchanges, stock code, market price, performance in comparison with broad-based indices such as BSE index, Sensex, Crisil index, suspend any securities which are suspended from trading. They will give the explanation and reasons for the director's report, will provide them. Registrar and share transfer, and these are all have to be disclosed in the annual report. Share under the corporate governance, share transfer system, distribution of shareholding, dematerialization of shares and liquidity, outstanding global depository receipts or American depository receipts or warrants or convertible instruments, conversion dates and likely impact on the equity, commodity price rise risk or foreign exchange risk and hedging activities, plant locations, addresses for correspondence, list of all credit ratings. Other disclosure which has to be given is disclosure material, significant related party transactions with potential conflict of interest, details of non-compliance by the listed entity, penalties, strictures by the stock exchange or board or statutory authority or capital market, details of establishment of vigilance mechanism, whistleblower policy, affirmation, compliance with mandatory requirements, adoption of the non-mandatory requirements, web link for all the policy determining material subsidiaries, all the related party transactions, commodity price risk and commodity hedging activities, utilization of the funds, raised to preferential allotment, qualified institution placements under Regulation 32(7)(a). A certificate from the company secretary in practice that none of the directors on the board of company have been debarred or disqualified from being appointed or continuing as directors of the companies by the board or Ministry of Corporate Affairs or any such statutory authority where the board has accepted any recommendation of the company committee of the board which is mandatory required in the relevant financial year. Same has to be disclosed. And total fees for all services paid by listed entities and its subsidiaries on a consolidated basis to statutory auditor and all entities in network from network entity of which statutory auditor is a part of it. The disclosure about sexual harassment of women at workplace, Prevention, Prohibition and Redressal Act 2013, number of complaints filed during the year, number of complaints disposed of, number of complaints pending, disclosure by the listed entities of subsidiaries of and subsidiary of loans and advances in nature of loans to firms incoming the directors are interested by name and amount, details of material subsidiaries of the listed entity in date, place, incorporation, name, date, appointment of statutory auditors, non-compliance of any requirement of corporate governance report of subparas 2 to 10 as above. The corporate governance has to disclose all the disciplinary requirements as per Part E of the Schedule 2, which has been adopted. The disclosures have to be done as per Regulation 17 to 27 and 46 to B to I, sorry. shall be made in the section on corporate governance of the annual report. The declaration signed by the Chief Executive Officer stating that the members of the Board of Directors, senior management personnel have affirmed compliance with the code of conduct, which is conduct of the Board of Directors and senior management as per code of conduct policy. The compliance study from either of the auditors or practicing company secretaries regarding compliance of conditions of corporate governance shall be annexed with the director's report. These are all the regulations of the Securities and Exchange Board of India. Index providers, delisting of equity shares, issue of listing non-convertible securities, share-based employees, board managers, portfolio managers, foreign portfolio investors, administrators, appointment, buyback, depositories, issue of capital, settlement proceedings, stock exchange clearing corporations. These are all the regulations which are required to comply by the listed entities, listing obligations and disclosure requirements, prohibition inside trading, infrastructure, investment trust, real estate, research investment, alternate investment funds, substantial acquisition, know your client, investor protection, intermediaries, securitized debt instruments, certification of associated persons, SROs, self-regulatory organizations, for fraudulent and infiltrated practice related to securities market, employee services, foreign venture, collective investment, trade, trading, custodian, mutual funds, bankers to the issued debentures, trustees, registrars, merchant bankers, stock. Now, next we come to all the relevant regulations of the corporate governance, which are given in the Securities Exchange Board of Listing Obligations and Disclosure Requirement Regulation 2015 as amended. The relevant provisions, Regulation 17 for Board of Directors, and as per Section 149 of the Companies Act. Regulation 17A is the maximum number of directorships. Regulation 18 is the audit committee, and as per Section 177 of the Companies Act. Regulation 19 is the nomination and remuneration committee, as per Section 178 of the Companies Act. Regulation 20, stakeholders relationship committee, which is covered under Section 178 of the Companies Act also. Regulation 21 of risk management committee, Regulation 22 vision mechanism, Section 177 and 9 and 10 of the Companies Act. Regulation 23 related party transaction, and as per Section 188 of the Companies Act. Regulation 24 corporate governance requirements with respect to subsidiary of listed entities. Regulation 24A secretarial audit as per Section 204 of the Companies Act and secretarial compliance report. Regulation 25 the obligation with respect to independent directors, and as per Section 150 of the Companies Act. Regulation 26 is the obligation with respect to employees, including senior management and key manager personnel, directors and promoters. Regulation 26A is the vacancies of the key manager personnel. Regulation 27 is other corporate governance requirements. 29 prior intimation. 30 is disclosure of events or information. Regulation 33 is for the financial results as per Section 129 of the Companies Act. And Regulation 34 is the disclosure of the compliance of the regulation of the annual reports as per Section 92 and Section 134 of the Companies Act. Regulation 35 deals with annual information memorandum, and Regulation 36 deals with documents and information to shareholders. And as per 136 of the Companies Act. Regulation 46 is the disclosure in the website which the listed entity gives. These are all the rules of the company's appointment and qualification of our directors' roles, 2014 committees of the board. Rule 6 is the board of directors of every listed company and company covered under Rule 4 of the company's appointment and qualification directors. Rules 2014 shall constitute an audit committee and nomination and remuneration committee of the board. Number of independent directors. Rule 4 following classes which shall have at least 2 directors are independent directors. Public companies having paid up share capital of 10 crores and above, turnover of 100 crores rupees, and aggregate outstanding loans, debentures, deposit exceeding 50 crore rupees, which requires a number of independent directors to be appointed in the listed company. The following classes of unlisted public companies shall not be covered: joint venture, wholly owned subsidiary, dormant company, as per Section 455 of the Companies Act. Women directors have to be appointed as per Rule 3 for every listed company, at least 1 woman director. For every other public company having paid up share capital of 100 crore rupees or more, turnover of 300 crore rupees or more. Omnibus approval for related party transactions on an annual basis are given by the Board of Directors and the Audit Committee as per Rule 6A for all the related party transactions. Approval of the Board of Directors, maximum value of transactions per transaction, the extent of disclosures reviewed at intervals by the Audit Committee. And they are all subject to approval by the Audit Committee, which is Omnibus. Audit Committee repetitive transactions are taken up by the Audit Committee past and the future. For justification for this Omnibus approval has to be justified and mentioned. Next we come to these are all part of the Omnibus approval by the Audit Committee on an annual basis. The name of the related party, nature and duration of the transaction, maximum amount of transaction, the indicative base price, any other information of Audit Committee, and which is in excess of 1 crore and per transaction. The all are given. An omnibus approval is given by the Audit Committee within one financial year. Next, we come to the vigil mechanism, which is governed by Rule 7 of the company's appointment and qualification directors Rule 2014. Companies have to establish a vigil mechanism for the directors and employees to report their genuine concerns and grievances which accept deposits from the public and which have borrowed money from banks and public financial institutions in excess of 50 crore rupees, which are required to constitute an audit committee which shall oversee the vigil mechanism through the committee, and having a conflict of interest, recuse themselves and others on the committee which deal with the matter on hand. In case of other companies, Board of Directors will nominate a director to play the role of audit committee for the purpose of vigil mechanism to whom other directors and employees may report their concerns. Vigil mechanism will provide for adequate safeguards against victimization of employees and directors who are aware of vigil mechanism, and also provide for direct access to the chairperson of the audit committee or director nominated to play the role of audit committee. In case of frivolous complaints being filed, the audit committee nominated to play may take suitable action against the concerned director or employee, including reprimand. Appointment of internal auditor is done as per Rule 13 of the company's accounts rules. Also, every listed companies, unlisted companies having paid up safe capital of 50 crores rupees, turnover of 200 crores rupees, outstanding loans or borrowings from banks or public financial institution in excess of 100 crores rupees, outstanding deposits of 25 crores and above. Every private company having turnover of 200 crores rupees, outstanding loans of 100 crore rupees or more in the preceding financial year. Next, we come to the matters which has to be included in the board's report as per company's accounts rules. So it shall prepare standalone financial statements of the company highlighting the performance subsidiaries, associates, and joint venture companies. The report as to particulars of contracts or arrangements with related parties has to be given under Section 188 of 1 of the Companies Act in Form AOC2. The report of the board shall contain the namely conservation of energy, impact of the conservation of energy, utilizing alternate sources of energy, capital investment on energy conservation for equipment, the technology absorption, the efforts made towards technology absorption, benefits derived like product improvement, cost reduction, product development, import substitution. Imported technology 3 years reckon the details of the technology, year of the import, technology being absorbed, percentage of absorption, all have to disclose the expenditure incurred on R&D, research and development, foreign exchange earnings and outgoes, and every listed other than have a period of 25 crores or more calculated at the end of the preceding financial year shall include in the report a statement indicating the manner in which formal annual evaluation has been made by the board for its own performance and that of its committees and individual directors. In addition, financial summary, change in nature of business, directors, key managerial personnel, the opinion of the board's integrity, expertise, and experiences, the names of the companies which cease to be its subsidiaries, joint ventures, details of deposits accepted, remained unpaid, defaults beginning, maximum, and the end of the year, and details of all the deposits have to be given, significant material orders have to be given, the adequacy of internal financial controls has to be the maintenance of cost records are required 148 to 1 of the Companies Act. A statement related to internal complaints committee and any sexual harassment of women at Workplace Prevention Prohibition Redressal Act. The details of application under any insolvency and bankruptcy code 2016. The difference between valuation at one-time settlement and the valuation done while taking loan from banks or financial institutions and reasons. All these rules does not apply to one-person company or small companies. Next, we come to the company's corporate social responsibility policy rules 2014. The companies, as per rule 5 of the CSR policy rules. Company mentioned under it shall constitute a CSR committee under 135(1) and appoint an independent director under 149(4). Private company having 2 directors shall constitute a CSR committee. Foreign company CSR at least 2 persons. One has to be appointed in 381D of the Companies Act, and another one member has to be appointed from the foreign company. The CSR committee shall recommend to the board an annual action plan in pursuance of the CSR policy, the list of CSR projects and or programs as per Schedule 7 of the Act, the name of execution of such projects or programs under Rule 4.1, modalities of all the installation of funds and implementation schedules, monitoring and reporting mechanism of projects or programs, details of need and impact assessment, if any, provided the financial recommendation CSR committee based on reasonable justification. It has to report under Annex 1 and Annex 2, and it has to comply with 381(1) under Companies Act for disclosing all the particulars in Annex 1 and Annex 2. It shall calculate the company having average CSR obligation of 10 crore rupees or more in pursuance of 135(5). In 3 immediately preceding financial years, undertake an impact assessment through an independent agency of their CSR projects having outlays of 1 crore of rupees or more. The impact assessment reports has to be placed before the board and shall be annexed to the annual report on CSR. The company undertaking social impact assessment may book the expenditure towards corporate social responsibility for that financial year. This shall not exceed 2% of the total CSR expenditure for that year, or 50 lakh rupees, whichever is higher. It has to be displayed, the CSR activities has to be displayed on its website as per Rule 9, with the composition, policy, projects, and place approved by the board of directors. Next, we come to the selection and appointment of our auditors by the audit committee under section 177. This qualification experience of the individual of the firm's appointment. The audit committee or the boards shall have regard to any order pending before any professional matter conducts of the Institute of Chartered Accountants of India, competent authority or any court. The audit committee, as the case may call for, such as the information proposed auditor has been fit, subject to sub-rule 1. Company may constitute an audit committee, recommend the name of an individual or firm or auditor. The board shall consider and recommend the individual or firm as an auditor of the listed companies at the annual general meeting. The recommendation by the audit committee is given for the appointment of the firm, and if anything has to be referred back, it will refer back to the audit committee with justifications and all. And rest of the thing, they are appointed AGM and hold office for conclusion of the meeting till the conclusion of the 6th annual general meeting. These are all the regulations and all the rules which are required for compliance for corporate governance in the Companies Act and the SEBI listing and obligations, disclosure requirements. And there are few recent master circulars which has come up dated November 11, 2024 for compliance of provisions of Securities and Exchange Board of Listing Obligation Disclosure Requirement Regulations with changes in all the reporting standards. And another one has come up on 12th of December 2024 also. So members are requested to go through it, which are being given by the SEBI notifications. These are all the appointment and qualifications of directors which are required under the Companies Act as per Chapter 11, Section 149, Board of Directors, Section 150, Data Bank of Independent Directors, 151, Small Shareholders Directors, 152, Appointment of Directors, 153, 154, 155, 156, 157, 158 deals with director identification numbers. Then 159 for penalty for default, any such default, retiring directors, section 160 of the Companies Act, additional directors, alternate directors, nominee directors as per section 161, directors which are voted section 162, proportional representation for appointment directors as per section 163, disqualifications of appointment of directors as per section 164, number of directors section 165 of the Companies Act, duties of directors as per section 166 of the Companies Act, vacation of office of director as per section 167 of the Companies Act, resignation of the director as per section 168, removal of the directors section 169, section 170 deals with the register of directors and key managerial personnel and the shareholding. Members' right to inspect is there as per section 1671, and penalty provisions are given as per section 172 of the Companies Act. Then we come to chapter 12 of the Companies Act regarding the meetings of the boards and its powers. Meeting of the board as per section 173 of the Companies Act. Quorum is decided as per section 174. Resolution by circulation as per section 175. Appointment directors not to invalidate actions as per 176. Audit Committee, section 177, Nomination and Remuneration Committee and Stakeholders Relationship Committee, section 178, Powers of Board, section 179, Restriction of Powers of Board, section 180, Companies to contribute to bona fide charitable funds, 181, Prohibitions, Political, 182, Power of the Board of making contribution to National Defense Fund, 183, Disclosure of interest by directors, 184, Loan to directors, 185, Loan investment, 186, Investment 187, Related Party Transaction 188, List of Contracts Section 189, Contract with Employment 190, Payment to Director for Loss of Office Section 181, Restriction on non-cash transaction involving transaction Section 192, Contract by one-person company as per Section 193 of the Companies Act. Schedule 4 deals with Code for Independent Directors, Section 149(8). Code is a guide to professional conduct for independent directors.
Rakesh sir, please conclude your presentation now.
Please. Yeah, okay, thank you. Faithful manner with confidence for guidelines for professional conduct, roles and functions, duties, manners of appointment, reappointment, resignation, and separate meetings and evaluations. These are all disclosures made in the annual report, introduction, board of director, integrity report, board reporting, value reporting, balance report, materiality reporting, management report, reviews, corporate governance report, corporate CSR, sustainability reporting, secretarial audit report, independent audit report, financial statements, consolidated. And these are all integrated report framing of BSR, IISC, GRI, FRS, and sustainability reporting, GRI, carbon disclosure projects, greenhouse protocol, ISOs, IFRS sustainability disclosure standards. All these are mentioned and one can see both rate. Akshatji, can I have the annual report TCS from your end?
Sir, please proceed for conclusion. We are running short of time.
Let's see. How much time do I have?
Just your time is over now, sir.
Time
for
is
the
over.
presentation. Yes, sir.
I see. Okay. I wanted to introduce few things in the annual report and
we
master
could
circular.
cover Q&A now.
Okay. Thank you very much from all the members and the Institute of Chartered Accountants. Thank you, Piyush.
Thank you, sir, for your time. We should cover some Q&A now. Just waiting for 10 seconds to collect questions there. So one question we have received, sir, how can companies improve transparency in related party transactions and avoid conflicts of interest? So it's regarding related party transactions, sir.
RPT Section 188 of the Companies Act deals with it, and Regulation 23 of the SEBI listing and obligation disclosures requirement regulation 2015 deals with it. One can go for that. All the reporting has to be done according to the regulations.
Okay. Okay, sir. Next question we have. So next question we have about the minority shareholder. So question is minority shareholder protection has been a focus of SEBI reform. Uh, could you highlight some provision, regulatory provision regarding the protection of interest of minority shareholders?
Minority shareholders, they have to, I have discussed earlier, corporate governance as per Schedule 2 and as per Schedule 5 of the regulations, it is required the minority shareholder disclosures have to be done. All the shareholding which the minority shareholders are holding, and they have to disclose any dispute in resolution. They have to come into resolution. They can give the reports to the board of directors. They will resolve the issue and address the issues, and they will go for vote on account accordingly.
Got it, sir. Got it. I think we are running short of time. Definitely, if we should have time, we should have answered more questions. But thanks to all the participants for asking the question. Now I should move towards the end of the session. As we come to the close of today insightful webinar on corporate governance, stakeholder from the stakeholder perspective. It is my honor and pleasure on behalf of the CP Committee of the Institute of Chartered Accountant of India to extend our heartfelt gratitude to all the participants and the speaker. We are deeply grateful to our esteemed speaker, CA Rakesh Chaudhary sir, for sharing his profound knowledge and perspective on this pivotal subject. Your insights have illuminated the pathways for the professionals to better understand and implement robust corporate governance practices with a clear focus on the stakeholder interest. Your expertise has undoubtedly enriched our understanding, and will serve as a guiding light for our professional journey. I would also like to express our sincere appreciation for all the attendees for your engagement and thoughtful questions, which have greatly contributed to making this session interactive and enriching. A special thank goes to the organizing team of CP committee and our technical support team to ensuring a smooth and seamless webinar experience for everyone involved in today's webinar. Thank you once again for being a part of this insightful webinar. We look forward to welcoming you again to our future event. Have a wonderful evening. Thank you so much, everyone. Goodbye.
Thank you. Thank you.